So your firm specializes in what's called value stocks, which means cheap stocks. You're not into the high technology, high flyers, but the high flyers have done so well
Crushed it.
in recent years.
Yes.
So has it made you think maybe you should get into that business as well?
As a contrarian, I think just the opposite. Whatever worked in the past won't work in the future. Most people fight last year's war. That's not how we think about things. You want to look and see what hasn't been successful, and that's where you want to be. So when we look at this past decade where large caps and growth have dominated in a way that we've never seen before, selling at valuations that we've never seen before relative to value or cheaper stocks, we see a tremendous opportunity. People think we're talking our book. We're not. I'm just looking at data. I love that line, math has no opinion. When you look at the math,
Right.
the differences in returns over long periods of time between growth and value and the divergence that we've had recently, you can't help but to see a tremendous amount of opportunity and value, especially with the backdrop of rising interest rates.
Warren Buffett has often said that people will be better off just put their money in stock index funds rather than people who are picking stocks, as your firm often does. You pick stocks. So what do you say to Warren about that?
Well, first of all, he's outperformed by not owning an index. So he's proof positive that it's possible that you can outperform the broad market. But more importantly, in our world, we believe in the efficient market theory, and the inefficiency is in areas that are overlooked, misunderstood. People don't follow it very well. And so that's smaller companies. They tend to be less widely followed. You also see that inefficiency in international markets. That's where we work and live at Ariel. And so we think we can exploit those inefficiencies in those areas, which is where we would say we would respectfully disagree with Warren Buffett.